Previously we got up to this slide and we were asking the question, where did the money come from to inflate housing prices in the United States, which eventually led to housing prices collapsing, and then that led to financial markets getting into trouble. So let's go back to basics and look at some macroeconomic fundamentals, and what I've got here is a simple model of interest rate determination, but it is for a closed economy. So in this economy there is no trade, there is no excess savings moving either in or out of the economy. So the only place that savings in this economy can be used is within the domestic economy. So the idea is investment is negatively related to the interest rate, savings positively related to the interest rate, and if this financial market that we are dealing with here is competitive, then the interest rate will move very quickly to IR1 and we will be at a point where savings equals investment. And so if financial markets are efficient and competitive and operate efficiently, then we'll quickly get to the point where savings equals investment in a closed economy. Now, the reason I'm discussing a closed economy is that it provides good contrast for consideration of an open economy. So this example of a closed economy is not really that realistic. There aren't too many economies in the world that actually operate like this, if any. And so let's move now to a situation where we're dealing with an open economy. So moving back here, we have this interest rate IR1. Now in reality that's the interest rate that would exist in a closed economy, but IR1 doesn't exist in reality. The interest rate is not ever going to reach IR1 in an open economy, so I think of IR1 as just a hypothetical interest rate if we were dealing with a closed economy. It's not an interest rate that would actually ever exist in the real world. So rather than having this hypothetical closed economy interest rate, let's deal with the world interest rate IR2. So we've already done a little bit of work understanding why it is that interest rates move very closely among particularly developed economies. So we've had a look at those 10-year bond yields in the US, Germany and Australia, and seen the high degree of correlation over time among those 10-year interest rates. So IR2 is at any point in time the world interest rate. So you can think of it as the interest rate in the United States and perhaps in London and Berlin as well, so the key financial centres of the world. That's the interest rate occurring on, say, 10-year money. So this could be the 10-year market that we're looking at here. And we're also assuming that the interest rate on 10-year money or 10-year bonds in Australia is IR2 as well. So it's pretty much IR2 in most economies around the world. Now I know that we have seen some long-term interest rates, Japan is a good example, which diverge significantly from the world interest rate. That to me is a bit of an aberration. Given long enough, 10-year interest rates in Japan will return to the world level. So we're dealing now with an open economy, hypothetical open economy. Savings and investment curves are in roughly the same place, but now this economy is open and it's subject to the world interest rate. Now at this interest rate, savings will exceed investment. So savings will be B, investment will be at point A, and the difference, the horizontal distance, B minus A, is going to be excess savings. Now, as we've already determined, that money will flow out of the domestic economy. It can't be left in the domestic economy because it doesn't have anything to do. We've got enough savings in this economy to finance all of the domestic borrowing requirement. Remember, the domestic borrowing requirement is A, and part of that will be investment, part of it will be debt finance consumption. So we've got excess savings, they've got nothing to do. They can't just sit there doing nothing. They can't just sit lying idle in the banking system. So eventually they will move overseas to try to earn a bit of a return. Now if we have a situation where we have excess savings in this country, then we're going to have a deficient level of savings in other countries, so we'll get money moving from this country to a country that is in a situation where savings are less than investment. Okay, in many Western economies though, at the world interest rate IR2, savings is much lower than investment. So if we take Australia as a good example, that gap between C and D, that horizontal distance between C and D, is around about $50 billion each year. I know that because I've looked at the balance of payments for recent years and found that over the last handful of years, around about $50 billion each year has flowed into Australia in the form of foreign investment. Now, foreign investment is the term used in the balance of payments to describe foreign savings coming into Australia and supplementing our low level of domestic savings. So when we get to the balance of payments section of the course, you'll need to remember that. So even though the balance of payments calls this inflow of $50 billion foreign investment, which it is, we're thinking about it in terms of foreigners lending us their savings, their excess savings. So in Australia we have a high level of investment because a lot of what we produce is very capital intensive, mining, energy, that sort of thing. So it's very capital intensive and we need a lot of investment expenditure to produce what it is we produce relative to other countries. A lot of other developed countries are sort of more service orientated than we are, and you don't need as much capital to produce services as you do iron ore, coal, natural gas, that type of thing. At the same time, savings is a little bit low in Australia. So savings, I've illustrated it there at point C. I'm just calling that some low level of savings relative to investment. And so why are savings low in Australia? Well, there's numerous reasons. I think it's a little bit cultural. We seem to be in a situation these days where people are happy to buy now and pay later. So that indicates that if people are willing to sort of buy now and pay later, they're using debt to finance a lot of what they consume, both houses, cars, other sorts of capital equipment, and also consumables as well. So if we've got that sort of lifestyle, the savings rate obviously is going to be quite low if we're actually requiring debt to purchase a lot of what we consume. Obviously savings are going to be low as well. Another reason why savings are low in Australia, we have the Medicare system, we've got a public pension system, and we've got unemployment benefits. So there's very little reason for a lot of Australians to, well, a lot of Australians think that there is very little reason for them to save. It's probably not the case, but a lot of people, because of that public health and the general welfare safety net that is provided by the Australian government, that puts a bit of downward pressure on savings as well. So you could probably come up with some other reasons why savings are a little bit low in a lot of Western countries, and why investment is probably on the high side in a lot of Western countries as well. Or maybe it's just that the investment's not overly large, it's just that savings are low. Okay, so moving on from that, we've got a situation where savings does not have to equal investment in an open economy. And on this slide I'm just reminding you that the investment that we've been talking about in this diagram, the investment curve, is actually representative of domestic borrowing. So what we have in this diagram is savings, which is the supply of loanable funds, and investment, that is the demand for loanable funds or the demand for borrowings. So in this slide I'm just indicating that domestic borrowing is a function of domestic investment spending. So most investment requires borrowing to finance it, and also debt finance consumption, which by definition needs borrowing to finance it. Okay, so then we get to the we continue on with the question, where did the money come from to inflate housing prices in the US? So the reason I went through this example and this example was to show that some countries have excess savings, some countries have deficient level of savings, and that is really the main motivation for money to move between countries, because of simply savings and investment imbalances. And looking at this diagram, we can see that in the United States, certainly from around about the mid-1990s onwards, there was quite a large gap between savings and investment, and it was actually a negative savings investment gap, so savings were less than investment. So that led to a large inflow of foreign savings into the United States. Now, because investment is actually equal to borrowing, we can see that investment in the United States was quite high relative to savings. So when savings dipped, investment remained up here close to 20%. Now remember, investment spending is also represents debt finance consumption as well. So really in this investment figure should be debt finance consumption type expenditure, which is financed by borrowing as well. So an important point here is that the level of investment spending in the United States, a lot of it was housing investment over this period, but a lot of it was also debt finance consumption. This investment spending remained high, partly because of the fact that a lot of money was being made available to America. So because a lot of other countries in the world were sending their excess savings to America over this period from the late 1990s onwards, America was then taking or borrowing that money. It was almost like they weren't asking for it, it was being given to them, and they were accepting that money. And by accepting that money, by actually borrowing that money, that's part of the reason that the investment figure here for the United States, the investment line, remained very, very high over this period. So to some extent it wasn't as if America was willingly undertaking a high level of borrowing. To some extent that was the case, but also when you have foreigners basically asking you to take their excess savings, very often you're in a situation, well, the Americans were in a situation where they weren't saying no. So the money was being handed to them rather than them asking for it. So where did the savings come from, the foreign savings come from that flowed into America? Well, it came from Japan, savings greater than investment. It also came from East Asia, China, other emerging markets in the mid to late 2000s, and it came from the oil producing countries as well. All of these countries had savings greater than investment, and so this money was actually moving from the east into the west. Now, one point to note here with East Asia, and it's really true for a lot of other countries, well, one point with East Asia is that they had experienced a big drop after the East Asian financial crisis in 97-98, a huge drop in investment, and it was that drop in investment that opened up the big savings investment gap. But because the East Asian financial crisis led to a lot of problems, economic problems, throughout East Asia, a lot of the countries in that region then, after the East Asian financial crisis in 97-98, made a deliberate decision to save a lot of money and invest that money in foreign exchange reserves. And so a lot of that money was actually going into America. It was purchasing government bonds. These countries were holding government bonds, and as soon as they hold a government bond, a US government bond denominated in US dollars, that is a foreign currency reserve, because those countries can quickly take those bonds, sell those bonds in the secondary bond market, and very quickly get US dollars. So after the East Asian financial crisis, right throughout Asia, a lot of countries were deliberately saving a lot relative to investment and using those savings to build up foreign exchange reserves. And quite simply, the US was the source of those foreign exchange reserves. They were the country supplying the or assets denominated in their country. Now I've got another question up here. Why did US banks begin subprime lending? What I've indicated on these graphs is that from the late 1990s onwards, there was so much excess savings coming from the East, or the countries that I've defined as being in the East, and primarily they were going into the United States. There was so much money coming in that eventually the American financial system exhausted all sensible lending. Now, a lot of this money was going into the housing market. It wasn't going to the stock markets because, as we've seen, the stock market crashed in the late 1990s. So it was the dot-com bubble bursting in around about 2001. So after that, people were very wary of stocks. So all of this money coming into America was going into the most sensible next best alternative, the housing market. The two biggest asset markets are the stock market and the housing market, and also, well, so the bond market as well. So there's three large asset markets there. People were very wary of the bond market and the stock market, financial markets in general. So as this money was coming in, it was being borrowed by US households and it was being poured into the housing market primarily. So why did the banks begin subprime lending? Because initially, as the money was coming into the United States, all of the sensible lending became exhausted, but the money kept coming from the East. And that is when the banking system in the United States started thinking about subprime lending. So they knew there were people out there willing to borrow money, people they believed they could make a profit margin from, but these people were very, very risky lenders. So the banking system did not want to lend subprime borrowers money and hold the risk. So that's where securitization comes into the story. And a lot of these subprime loans were actually securitized through the creation of something called mortgage-backed securities. Those mortgage-backed securities were then sold off to individual investors all around the world, and that is the way that the banking system in the United States got the risk associated with subprime lending off their loan books. So that explanation there is about as deep as I'm going to go in some areas of the global financial crisis. So hopefully that'll highlight the fact that if you don't know what subprime lending is, you have to go and figure it out for yourself at the end of this presentation. The same with mortgage-backed securities. If you're not sure what a mortgage-backed security is and how mortgage-backed securities were used to spread the risk associated with very questionable lending all around the world, you need to do some research on that. Okay, what was the preferred currency? So all of these savings were pouring out of the countries in the East and they were going into the US. We can see in the graph on the left here that the US dollar is by far the largest global reserve currency in the world. So a lot of this money was actually pouring into the US because the US simply has the largest bond market in the world, and it was the only financial market large enough and sophisticated enough to absorb all of this inflow of foreign savings. And you can see the size of the US bond market here. It's about $25 trillion, so that's pretty huge. The next largest is Japan and Euro, which also absorbs some of this money, but by far the United States absorbed the bulk of it. So why did the money flow into the US from the East? Because the US had the most liquid and the largest bond market. A lot of the money was going into the bond market, not the stock market. So international investors wanted to hold bonds because they perceived them as being safer than US real estate or US shares. But we've got to be careful here. Even though it was the foreigners from the East were buying bonds and holding bonds as their foreign exchange reserves, the money was going through the bond market and it was being used by the banking system to finance housing lending. So hopefully that makes sense. So you would have a Japanese pension fund buying for example, a US government bond for say let's say $10 million. Nice round number. So the Japanese pension fund would hold the US Treasury bond for $10 million. Now, the seller of that, let's just imagine that it was a bank in the United States that was holding that bond. They've just sold that bond. Now they've got $10 million in cash. They are then going to lend that money on to the next customer. and a lot of that money was being channeled into the housing market, as I said. Okay, so a lot of that money was going to the housing market. At the same time, a lot of the money that was coming from the East was purchasing bonds issued by the banking system as well. So bonds issued by the banking system was then a way of the banking system taking in that money. Then they would use that money to either lend to customers, or towards the end of the global financial crisis, a lot of that money was actually being borrowed to short term to create mortgage-backed securities. But either way, the money was coming in, it was going into the housing market. Then there was the strength and the stability of the US dollar. International investors wanted or preferred the US dollar as a reserve currency. Point number 3, the US households and firms, they were the ones who were willing to borrow the money coming in. So at the time, people in the US were, in hindsight, a little bit overconfident about the future, and as I've been saying right throughout this course, you can't send money to a country like the United States if someone in the United States is not willing to borrow it. So even though there was a lot of money coming from the East into the US, at the same time, people in the US were actually willing to borrow that money. And finally, the US had free capital mobility. So that means that they had a completely open capital financial account in the balance of payments. That'll make more sense later in the course. But just for now, it means that there was ease. It was very easy for money to move in and out of the US economy. Why is that important? Let's just imagine a Japanese pension fund has $1 billion that they want to invest in the United States. Knowing that they can move that money into the United States freely and out freely and very quickly would be very reassuring to that pension fund. So therefore, very good reasons why the United States was the target of most of this money that was coming out of the East. Okay, the next slide is on global imbalances, but I'll leave this particular presentation there and come back with a separate presentation on starting with global imbalances.